CVS Health trades at approximately $95 per share for a market value of $121 billion. At that price, our reverse DCF implies approximately 6.7% annual unlevered free cash flow decline for the next 10 years. That price-implied path takes estimated unlevered free cash flow from $14 billion today to $7 billion in year 10, 0.5 times the current level. Over fiscal 2022 to 2025, reported free cash flow declined by 16.6% per year. That is the delivered record beside the price-implied 6.7% annual decline path. Is this low-modeled hurdle justified, or are important risks missing? To answer that, we run the valuation through three lenses. A reverse DCF reveals what the current price already assumes. A traditional DCF estimates what the business could be worth under bear, base, and bull scenarios. And a price-to-earnings multiple adds context from comparable historical and market anchors when those are available. Three lenses. One conditional verdict. We model CVS Health's cash engine as members to premium yield to medical margin to free cash flow. The template's proposed defense is scale against providers and the data behind pricing. Negotiating rates for millions of members is an advantage a new entrant cannot assemble quickly. For an upside case to hold, four things must be supported: membership growth, premium pricing, medical cost trend, and return on capital. We will test each one later. Before the valuation, the track record. What has CVS Health actually delivered? Over the last 3 years, revenue grew approximately 7.6% a year, earnings per share declined approximately 24.7% a year, and reported free cash flow declined approximately 16.6% a year. Reported free cash flow margin moved from 4.2% in fiscal 2022 to approximately 2.8% for the latest trailing period. In the quarter ending June 2026, revenue grew 7.3% year over year, broadly in line with its recent trend. The question is whether that continues. CVS Health is not currently earning its cost of capital. Our normalized return on invested capital estimate is roughly 5% against a discount rate of 6.2%. You can see it on the chart. The stock has lagged the broader market over this period. That relative weakness is useful context for the valuation, but recent growth is the starting point of this analysis, not the forecast. The question is never what was delivered, it is what the price now requires. At the time of this analysis, CVS Health trades at approximately $95 per share for an equity value of roughly $121 billion. Estimated trailing unlevered free cash flow is approximately $14 billion. A traditional DCF starts with forecasts and calculates a value. A reverse DCF does the opposite. It takes today's value and solves for the growth rate that makes the price possible. We use a discount rate of 6.2%. The company's estimated cost of capital, terminal growth of 2.5%, and the company's estimated unlevered free cash flow base. One adjustment first. CVS Health carries net debt of about $62 billion, so we solve against enterprise value rather than the headline market cap. The result, on these assumptions, today's price implies an annual unlevered free cash flow decline of approximately 6.7% over the next 10 years. And that conclusion is not fragile. Across reasonable discount rate and terminal growth assumptions, the price still implies a decline. That path takes unlevered free cash flow from $14 billion today down to approximately $7 billion in year 10, 0.5 times the current level. Watch it fade year by year. Year 1 comes in around $13 billion. By year 5, approximately $10 billion. And by year 10, $7 billion, each year a little lower than the last. Under a constant margin translation, holding the current estimated unlevered free cash flow margin at 3.1% maps the modeled path to approximately $227 billion in annual revenue by year 10. That is a model result, not a claim that the price is justified. The market is not pricing in a collapse. It is pricing in 10 years of slow decline. The bar is low, and it stays low, but does our own forecast produce the same value? Now I forecast the business itself. $415 billion of trailing revenue, and how much of it turns into unlevered free cash flow. The base path starts at 5.2% and fades toward 3.3%. That is trailing revenue growth blended with forward analyst consensus. Cash conversion drifts down slightly from 3.4% of revenue today to 3.1%. With a 6.2% discount rate and 2.5% terminal growth, That produces $284 per share. That discount rate is a market value weighted average cost of capital, built from a 4.7% risk-free rate, beta of 0.7, 4.5% equity risk premium, and 4.1% pre-tax debt cost. About 70.7% of modeled enterprise value comes from the terminal value, so the result remains sensitive to long-run assumptions. The bear case starts at 4.5% growth and assumes cash conversion never improves at all, holding at 2.4%. It is worth $204. The bull case starts at 6% and reaches 4.2%, the best margin it has ever posted. It reaches $400. The width of that range is not our opinion. It is the spread between the highest and lowest analyst revenue estimate, and here they are unusually close together. At $95, the stock sits below even our bear case. The DCF gives us a value. The multiple tells us what investors are paying for it right now. Our final lens is the valuation multiple. CVS Health trades at approximately 25 times trailing earnings. Based on expected forward earnings, that falls to approximately 11.2 times. The gap reflects the growth analysts already expect. The company's own median across 4 fiscal observations is approximately 18 times. The broader market trades at approximately 24 times on a configured trailing price to earnings benchmark. A high multiple is not automatic evidence of overvaluation. The question is whether earnings can grow fast enough to justify it, and that is exactly what the DCF already measured. The valuation survives mathematically, but only if a few conditions keep holding. Now the evidence. Membership growth is mixed. Revenue grew 7.3%, but the data does not isolate membership growth. Premium pricing is mixed. Revenue growth of 7.3% and reported free cash flow margin of 2.8% do not isolate pricing. Medical cost trend is at risk. Reported free cash flow margin is 2.8%. 1.3 points below the oldest year. Return on capital is at risk. Return on capital of roughly 5% is below the 6.2% cost of capital. None of 4 are supported. Membership growth, premium pricing, medical cost trend, return on capital remain unresolved. The verdict remains conditional. Now stress the model. The business risks are membership loss, medical cost inflation, regulatory and reimbursement. The screen translates them into exact valuation inputs. First, cut starting revenue growth to 70% of the base assumption. Fair value falls to $262. Second, reduce the steady-state free cash flow margin by 20%. Fair value becomes $227. Third, raise the discount rate from 6.2% to 7.2%. Fair value becomes $213. Finally, combine all 3 while fading mature growth to the terminal rate. The model falls to $150. These are standardized model stresses, not predictions. They show which assumptions the valuation is most exposed to. These risks do not need to destroy the business. They only need to produce results below what the current price already requires. The standardized stresses show how the valuation moves. But before the verdict, there is one counter-argument this analysis owes you. The price is not asking this business to grow its cash flow, so there is no funding question to answer. The question is whether the decline it prices in is the right one. That is the last piece of evidence. So what do all 3 lenses say together? 3 lenses. Here's the verdict. Lens 1, the reverse DCF. The price only asks for free cash flow to fade 6.7% a year over 10 years, an implied free cash flow path well above what the company recently delivered. Lens 2, our own DCF, $204 in the bear case, $284 in the base case, $400 in the bull case, and the current price sits below even our bear case. Lens 3, the multiple, a premium on trailing earnings, but roughly in line with its own median across 4 fiscal observations, once you account for the growth analysts already expect. The combined downside case lands at $150, approximately 57.9% above the current price. Add the 3 together, and something unusual appears. The price sits below even our cautious scenario, roughly 199.6% upside to our base case. Either our assumptions are too generous, or the market is pricing risks the model does not capture. The gap is a result to investigate, not proof of an opportunity. So what would justify today's $95? Free cash flow would have to follow the 6.7% annual decline the reverse DCF backed out, while our forecast points the other way. That distance is the expectation gap. The returns CVS Health earns on capital are thin on our estimate, which is part of why the price sits where it does. Our overall verdict, below our modeled bear case. Business quality and investment value are different questions. This conclusion remains conditional on the evidence and assumptions shown. That is the analysis. Thank you for watching. This analysis is a valuation framework, not financial advice. The result depends on the assumptions shown, and you should always verify them and do your own research. Snapshot, August 19th, 2026. Position not disclosed. The description lists sources, method, and AI use.